Hi guys, welcome back to Xeng Yung. Today I'm going to answer the question, should I invest now or should I wait for the market to crash? This is a disclaimer. Please do your due diligence first, and all that I'm saying in this video is for entertainment purposes only. With that said, let's get right into the video. At the time of recording this video, we are in a pandemic. There are very high unemployment rates. There are very bleak numbers of the economic data, and we are expecting a global shrink of the economy. And yet, the stock market is rising. So how do we actually know when the market will crash? The ideal strategy of investment is buy low, sell high. But how do we actually know that we are in a market low? Or how do we actually know that we are in a market high? We can't actually predict the future, right? Well, if you use this strategy, knowing whether the market go up or down is not necessary. So to attempt to answer the question, should I invest now or should I wait for the market to crash, I'm going to tell you a story of these three friends. So I found this video on Personal Finance Club, and this is a story of three friends who all saved $200 per month and invested in an S&P 500 index fund. So these friends are Tiffany, Brittany, and Sarah. Each saved and invested over the last 40 years, means from 1979 to 2019. But they had different strategies about when to jump into the market. So these are the major market crashes for the last 40 years. You can see Black Tuesday, drop of 33%, Kuwait War, drop of 20%, and the dot-com crash of the 2000s, drop of 49%, and finally the latest one is Global Financial Crisis, where there's a drop of 56% in 2008. Tiffany and Brittany knew the market could be volatile and planned to avoid the crashes. So this is Tiffany. She saved $200 a month in savings, earning 3% interest and waiting for the perfect time to invest. It turns out Tiffany had the world's worst timing. She dumped all her savings into the market the day before the 4 biggest market crashes. But she never sold. So even with her terrible timing, thanks to her buy and hold strategy, Tiffany's $96,000, means $200 times 12 months times 40 years is 96,000, turned into $663,594. So basically she just times 6 her initial investment amount. This is terrible Tiffany. Now, we got another friend, Brittany. She also do the same thing. She save in her savings account 3%, and then she waits for the perfect time to buy. And it turns out Brittany had the world's best market timing. She bought the day when the market was the very lowest after each 4 crashes. So it means every time the market go down and crash, she's the first one who buy, and then she get the most discount in the market. Brittany's perfect timing earned her $956,838. That is nearly 10 times the initial investment amount of 96,000. 96,000 becomes 956,838. So that's very good, right? Now, guess what did Sarah do? You can pause the video and comment below. Then you can continue and see whether your comment is correct lah. So now we go to Sarah. So this is slow and steady Sarah. Sarah really didn't have much interest in watching the market or trading. In fact, she only did one thing. So on the day she opened the account in 1979, she set up a $200 per month automatic investment in the index fund and never looked at her account again. In the end, Sarah's account has $1,386,429. So basically, Sarah has 14 times the value of what she initially invested. This is the conclusion of the story. You can see Tiffany, Brittany, and Sarah. Sarah has the highest amount after 40 years, right? The moral of the story is, remember, time in the market beats timing the market. So it is important to invest early and often. So if you find a lot of value in our video, do smash the like button and do subscribe to Xeng Yung. Do you enjoy the story about the three friends? It's mind-blowing, right? The amount of money that you can make just by being in the market instead of just timing the market and finding the perfect time. You know, it's better just to close your eyes and just invest into the market. The method used by Slow and Steady Sarah is actually called dollar cost averaging. Dollar cost averaging simply means investing the same amount of money on a regular basis regardless of the rise and fall of the stock market. For a new investor who don't have the time or don't have the necessary knowledge to learn how to invest into the stock market, this is the best strategy. Even the greatest investor in the world, Warren Buffett, has continually advised new investors who do not have the time and effort to learn about investing to just invest into the S&P 500 index fund. Remember, this strategy only works if you invest into exchange traded funds that track mega economies like China and USA. It would definitely not work in slow growth economies like Singapore and Malaysia. It would also not work if you were to invest your money in individual stocks using the dollar cost averaging method. To buy stocks individually, you would need to learn value investing. So do subscribe to Accent Yung and click the notification bell icon so that you get notified when we post the value investing method right here, right? So now we're going to bring things down back to reality. Okay, you want to know what is the S&P index, right? The S&P index is called the Standards and Poor 500 index. So this index is the one that tracks the US economy, United States of America's economy. Okay, so inside this index there are 500 companies, hence the name S&P 500. So in these 500 companies, these are the top 500 companies in the US. Then to buy the index, you can't actually buy the index, so you have this thing called exchange traded funds, ETF for short. So ETFs are funds that replicate the index. Okay, so what it does is it automatically buy 500 companies within the index, and then the fund itself sell their portion of whatever that they buy, the pot that they buy, to investors like us, right? So this means that you can buy 500 companies in the US by investing in very small capital. Currently, the S&P 500 index, SPY is a ETF under State Street Global Advisors, and currently it's only $290 US. And for Vanguard ETF, which is VOO, it's only $258. So it's in a range of below $300 lah, $300 US. So for a Malaysian, that would cost 1,200 ringgit. For a Singaporean, that would cost around 420 Singapore dollars. So it's a very, very small amount, right, to own 500 companies. The story of the three friends are based on the past market performance of the S&P 500 market index of the USA. So if you were to invest like Sarah from 1979 up to 2019, you will get 1.3 million US dollars. So the answer to the question, should I invest now or should I wait for the market to crash? The answer is no. Actually, you don't really need to wait when the market will crash to start investing. You can start investing now in small chunks and do the dollar cost averaging method into an S&P 500 index fund. That way you can still take advantage of the rise in the stock market. If some of you are skeptical on the calculations, do check out the Excel file in the article link below. All the numbers are there to calculate and verify the S&P 500 market performance over the last 40 years. This is how the three friends invested. They invest in an index fund via an ETF. So, where and how to purchase an ETF? So in Singapore, you can go to a local brokerage, and these are the most famous ones. And in Malaysia, you can also go to a local brokerage. These are the most famous ones. And in US, you can go purchase your stocks via TD Ameritrade and interactive brokers. With that said, I conclude this video that the time in the market beats timing the market. So invest early and your cash will work hard for you. Thank you for watching, and please smash the like button and subscribe to X and Yung for more wealth hacks like this.